Wood of Jefferies sees Sensex reaching 1 lakh points by late 2026. Morgan Stanley sees Sensex at 1 lakh by 2027. Individual investors like us can never get into such deep dive research, but still we can do a reality check ourselves to come up with our own answers logically and try to take the wise investment decisions based on it. This video will throw light on how to keep track of the growth in Sensex and its impact on commoners like us. Welcome to holisticinvestment.in. Before we debate as to whether Sensex will reach 100k, it is worth seeing this journey all through these years. Let us discuss the contributing factors that have led to this milestone. April 1, 1979, the Sensex debuted with a base value of 100. 1990, the first 1000. Indian growth story starts to kick in with many corporates starting to grow. 1992, the journey from 1000 to 4000, probably the second most bullish period of Indian stock market. Then came Mr. Harshad Mehta taking back the index to the levels of 2000. Year 1999, first major milestone of 5000. Growth fueled by a rebound in agriculture and allied sector and the election of first full-time non-Congress government. 2006, the first time Sensex achieved the 5-digit mark, 100 times growth in little over 26 years, staggering. 2007, Sensex reaches 20,000, a double from 10,000 levels in just 18 months. This was on the back of huge buying from foreign institutional investors and increased retailers. 2008, the year of fall, Sensex nosedived to 8,000 levels on the impact of subprime mortgage crisis. 2014, Sensex reaches 25,000, bouncing back from the lows of 2008. Over 3 times return in steady 6-year period. 2019, 40,000, scaled in little over 41 years. Yet another peak took out. India continues to flourish as the threat of US-China trade war escalates. 2020, the COVID slump. Fall from 42,000 to 25,000, wiping all the substantial gain made in over 4 years. 2021, February, sharp rally post-COVID saw Sensex double from 25,000 levels to 52,000 in less than 12 months. 2021, September, Sensex breaches the 60,000 mark for the first time, fueled by the China plus one narrative. 2022, May. Due to Russia-Ukraine crisis, Sensex was unable to sustain 60k levels and broke down until 51,000 level. Truly a roller coaster ride, isn't it? Imagine that if you had invested rupees 1 lakh in the Sensex in 1984, it would have turned into 1 crore in the next 30 years. The seesaw Sensex. The graph here shows the return of Sensex over the year since its inception. So looking at this, you can easily say this is a good instrument and it has compounded year after year. But when the market heavily crashes, would you as an investor be in the same mindset as earlier? The data points marked in red indicate some slump in the Sensex. The fall of 52% in 2008 was no small and may have wiped out all the weak hands from the market. In contrary to the periods in red, just look at the years marked in green immediately succeeding the red ones. We see stellar returns and the markets have erased all the losses and have rebounded from the lows, scaling newer heights. These were not only a V-shaped recovery, but the run-up persisted for more than a year. The overall CAGR is 16.47%. Next comes the number game. Now that we have seen that the Sensex average return over a longer time frame is 16%, let's plot different scenario as to when we can expect the milestone of 1 lakh to be taken over. Scenario 1. Considering the current growth rate of 16% annually, at the current rate we are going to reach our target in the next 3 years, which turns out to be a very good instrument to invest in. Scenario 2. Let us consider a modest return of 5 to 7% for equities as seen from global and Indian pieces of evidence and see how the number adds up. The 7% return help us attain our goal. in 7 years from now, which is 2030. Not bad, isn't it? Scenario 3, the case of unknowns. During all these years, we have seen several market crashes. So, what makes it to reach 1 lakh from those levels? Let's say we hit the COVID lows of 25,000 and assume growth at the annual CAGR of 16%. We can hit our landmark in another 8 years from now. In other words, Sensex has given more than 4 times return in 8 years. All these three scenarios indicates only one common underlying fact, that is the Indian equity market is bound to go up in the longer term. We have faced so many geopolitical issues, conflicts and pandemics, but still we are gradually moving forward thanks to our country's healthy growth outlook. Okay, so it looks like that some way or the other we are going to breach the magical figure of 100k in the future. But what substantiates this climb? By any chance, will India pass through an economic crisis like Sri Lanka or Pakistan? The following points would give an idea of how macroeconomics of India look like. India to be the third largest economy by 2027. As per Morgan Stanley, India is set to add $400 billion every year. At this rate, we will be $11 trillion over the next decade, making it the third largest economy in the world after US and China. China plus one narrative. The trade tensions between US and China have further contributed to the growth of industries in India. Post COVID, the China plus one narrative has kicked in, and this can result in a spurt in the manufacturing and pharma industries. More disposable income. The income of people in India is also increasing. Higher earnings mean higher spending, and this will result in an uptick in the economy. Rising capex. Increasing capex by companies means more infrastructure growth and more jobs. This will also lead to a higher rate of employment and will put money into people's pocket. Digital economy. Thanks to Aadhaar, India has created biometric IDs and proof of residence and has been instrumental in digitizing financial transaction. This digitalization has led to lowering credit cost, making loans more accessible and affordable both for consumers and businesses. What it takes to be part of this growth story of India and what should be the strategies to build long term wealth. It is high time that we take cognizance of all this and reward ourselves. Magic of mutual funds. When the Sensex reach our designated target in say 3 years, the Sensex would have grown by CAGR of approximately 18%. Likewise, mutual funds can also replicate the same or some of them far even better. Mutual funds are pretty good instruments that especially cater to long-term investors. Actively managed mutual funds have fared even better when compared to passively managed funds. Take for instance Nippon India Small Cap Fund, which has been outperforming the benchmark index handsomely by a whopping margin of 8%. This fund has been one of the star performers in the last 10 years and has created wealth at a CAGR of 24% in the same period. A point to be noted here is periodic evaluation of mutual funds are necessary to generate handsome returns in the longer run. Timing the market versus time in the market. None in this world can predict the market, and we retailers aren't an exception in this either. Research shows that those who stay invested over the long run in a well diversified portfolio will generally do better than those who try to profit from turning points in the market. A classic example in the Sensex returns over a longer period that was illustrated in the beginning. When to invest in equity and when not to. To leverage all the above growth aspects of India, the only way to make some gains for ourselves is via investing in equity. It is not worth investing entirely in equity markets for financial goods that are less than 5 years away. Just in case, if there are any root shocks to the equity market, the portfolio may be down and you may miss out on achieving the target corpus for your goals. So, for goals of more than 5 years, equity investing is a must. Fear of knowns and the unknowns. The known fears such as rising inflation and change in repo rates by the apex banks are some of the risks which may negatively impact our portfolio. We have seen that all of these can be negated in a short period and we should stay away. The fact is, the unknown fears are the ones that cause a major disruption in the financial markets, like the COVID crisis, Russia Ukraine war, or the subprime crisis. But we all know how we navigated through the rough seas and turned profitable in short durations, and we have made new heights time and again. A video link is given in the description to help you out regarding the steps to be taken as a retail investor during Sensex crashes. Bottom line, we as an economy are poised to grow, and this decade is India's decade. Eventually, we are going to breach the 1 lakh in Sensex and may go even further, creating newer highs. Let's be patient and travel together in this decade of development of India. Happy investing. The detailed blog post on this topic is in our website and the link is given in the description box. Hope you like this video. If you have any questions related to this or any other investment option or related to your financial goal, don't hesitate to book a free appointment with our financial planners. The link to the free booking is given in the description box below. Also, will you be interested to attend any insightful investment webinar? Then feel free to register for the upcoming Enlightening Investment Webinar. It is completely free. The registration link for the upcoming webinar is also given in the description box. If you like this video, please give us thumbs up. Also, share it with your social circle. If you haven't subscribed our YouTube channel so far, please subscribe now.